Hello and welcome to this special edition. We're trying to figure out what to expect from the interim budget this time around. Is it going to be a pitch for politics, or is it going to be a pitch to try and prop up the economy, or is it going to be a balancing act for both politics as well as economics? Let's try and figure that out, and we've got two experts joining us on the show. I've got with me Sonal Varma, Managing Director, Chief Economist, India and Asia ex-Japan at Nomura, and we also have with us Pranjul Bhandari, Chief Economist, India and Indonesia at HSBC, joining us on the show. Pranjul, Sonal, both of you, thank you so much for taking the time out and joining us today. Pranjul, we've had fairly buoyant tax revenues this time around. What do you think are the numbers that the government is going to project when it comes to the fiscal deficit?
Yeah, thank you for having me. So I think the government is going to be very focused on the fiscal consolidation path. Remember, it wants to go from 5.9% of GDP fiscal deficit in FY24 to 4.5% in FY26, which means that the midway year, which is FY25, should be around 5.3%. And I think that's going to be the real target around which all the maths of the fiscal will be done. Now, the government has been extremely lucky. Tax revenues have been far higher than what they've been projecting. Tax buoyancy, in FY24, last 12 months, was budgeted to be 1, but it turned out to be 1.6. So there was a lot of extra money which the government could play around with. And our sense is that it's going to remain north of 1 even in FY25. So our sense is that, tax revenues will grow at a higher clip than nominal GDP growth even in FY25, providing it enough money, to be able to bring down the fiscal deficit without being a big drag on India's growth.
Pranjul, while it is a vote on account, it being an election year, the Feb 1st budget this time around will also sort of set the tone for other state budgets which are going to eventually follow. You think there is any micro announcement that one can expect?
Well, look, a couple of things. One, I think it's very important to sort of take a step back and see what really drove growth in FY24. I think it was a lot of government capex that drove growth. But, it's not just central government capex. In fact, I would argue that central government capex grew by about 22%. The real growth in terms of capex came from state governments, which grew about 45% year on year. So states have been a big contributor to India's GDP growth in the last year. And our sense is that in the next year, both the central and the state government growth could be a little slower because the center has to bring down the fiscal deficit and the states have sort of hit their ceiling. They're not allowed to borrow too much money beyond 3% of GDP target. So our sense is that both center and state are going to see softer growth rates in expenditure over the next 12 months.
Sonal, if I could get to you then, you think it's going to be a bit of a balancing act between politics and economics, or do you think one would lead the other?
We do think it's going to be a balancing act. Of course, this is a pre-election budget, so we do think the announcements will be geared towards some of the constituents. So as the BJP has flagged its Gyan strategy in terms of focusing on the poor, youth, women and farmers, we do think allocations to these specific schemes will increase. But not at the cost of fiscal consolidation. I think the medium-term aim of getting the deficit down to 4.5% of GDP by FY26 is an intent of the government, and FY25 is therefore and sort of an intermediate target to get there. So that balancing, I think, as Pranjul said, will partly be achieved by slowing the pace of capex growth slightly in FY25.
Just taking a leaf from what Pranjul was highlighting earlier, that we've had very buoyant tax collections. You think the government's fiscal deficit targets would be easily met?
For FY24, you mean?
Yes, and 25 as well.
Yeah, so FY24, I think there are moving parts. So on the positive side, we've had higher direct tax collections. Dividends have been stronger than expected. But there are also certain disappointments. So nominal GDP growth is lesser in terms of the value. The indirect tax collections have been lower. Disinvestment proceeds are lower. And on the revenue expenditure side, particularly on specific subsidies, the total allocations are actually higher. So there are sort of positives and negatives. We do think the commitment to 5.9% is there, and it will partly be met through these offsetting factors and partly by mildly slowing the pace of capex growth relative to the budget target in FY24. So we do think it'll be achieved. Now, FY25, the 5.3%, so our expectation is that the government will set a deficit target of 5.3% of GDP. And backing it, we think will be an assumption of nominal growth of around 10.5%, compared to the very high buoyancy we've seen on direct taxes in FY24, which is like 2.4 times compared to typical, direct tax buoyancy of around 1.5. We do think government will be conservative. So the buoyancy estimates on average should be closer to 1, direct slightly over 1, indirect tax slightly below 1. So underlying those assumptions, plus the expectation of a slowdown in capex growth, although still robust, I think 5.3% of GDP can be achieved.
So, assumption when it comes to the capex rate?
So when it comes to the capital expenditure, I think both the quantum and the timing are important to remember when considering FY25. So in terms of the absolute quantum, the growth rates will slow. So FY24, we think the final central government capex increase will come to around 26-27% on a year-over-year basis, still quite robust. For FY25, we are expecting central government allocation to moderate to around 16% on a YOY basis.
But Pranjul, government capex and a strong one at that, despite fiscal consolidation, has what sort of, chugged or driven the economy all through the past fiscal. Now that the fiscal impulse is going to sort of slow down a little bit, you think the drag would be limited or would it be a big jolt?
So from our perspective, we do think there'll be a slowdown in real GDP growth in FY25. So compared to advanced estimate, which is 7.3, our own estimate for FY24 is around 7%. We think real GDP growth will slow down to around 6% in FY25. One reason is the moderation in both central and state government capex. The second reason is really on discretionary side of consumption. The tight liquidity we are seeing in the banking system, plus the tightening in macroprudential norms on consumer lending, we think will moderate some bit of discretionary demand going forward. And finally, I think, the terms of trade have been a major growth tailwind for India this year. We can see that in terms of, 20-25% profit growth versus sales growth that are low single digit. That, of course, came through because of the decline in commodity price and greater profits for companies. That incrementally, that benefit may not filter through in FY25. So we do think there'll be some moderation on account of that. And just one final point, I think the composition of growth still remains quite uneven. The rural-urban split and the public versus private capex split, we are still not seeing a broad basing of the private capex cycle yet. So, we are building in some moderation in growth next financial year as a result of those factors.
Pranjul, what are your thoughts here? You think the drag on the capex slowdown till the new government is formed and, again gets back to capex announcements, you think the drag is going to be limited or will it have a material impact?
As we pointed out before as well, we think both state and central government capex is going to grow at a slower clip in FY25. Now, both of them were very high in FY24, and actually that was a blessing in disguise. There was no private sector capex takeoff that we had expected earlier, so that didn't really happen. But what instead happened was that there was construction-led demand wages for rural Indians. A lot of rural Indians who were disappointed because it was an El Nino year and their production was weak, their wages were weak, were able to get alternate employment in the construction sector. And if we track the remittances from urban to rural India, that really took off over the last 12 months. And that basically, gave some cushion to rural incomes. And that's why today we are not in a position of a big rural distress that a lot of people had feared. So, government capex helped in more than one ways. But I think in the next 12 months, we have to become very careful because this kind of sort of support may not be there. In fact, when we calculate our fiscal impulse and we sort of account for better quality spend now that the government is doing far more capex, for the first time since FY19, we think in FY25, there will be a drag on the economy. The fiscal impulse will turn negative. Now, is this all bad for growth? Maybe not, because our sense is that if fiscal is taking a step back, we're expecting monetary policy to take a step forward, and we think the central bank will be able to keep much more looser monetary conditions over the next 12 months than it has done over the last 1 year, and that instead could become the support to growth. So FY25 is going to be a very interesting pivot year in which the government takes a back seat, but the central bank takes a step forward. Now, how will the central bank do this? Our sense is that it won't be in any hurry to cut the repo rate. The global environment remains far too sort of uncertain. The Red Sea issues, there are elections across the world. Our sense is they're going to use, the more nimble parts of their policy tool, which is liquidity. They tightened liquidity substantially over the last 12 months. Our sense is they're going to ease liquidity. And to be very honest, just by easing liquidity, they can actually de facto give you a rate cut, something that feels like a rate cut of about 40 to 50 basis points. In fact, just going by the actions of the central bank, last week, they have increased the amount of liquidity they are ready to give in their 14-day repo window, in their 2-day repo window. And I think actions like that will continue. And overall, monetary easing will be the way ahead over the next 12 months.
Sonal, wanted to get your thoughts on the point that Pranjul was just making, that more than Parliament, eventually next year, or rather this year, is going to be about what the RBI actually does. The ball is going to be in their court, and the shift will be totally towards the monetary stance as opposed to what the government does.
Yeah, we agree. I would agree with Pranjul's assessment. I think if you look at the current state of play, we do think liquidity conditions are way too tight. Some of this has happened because of government's high cash balance, but ultimately this is putting a lot of strain on banking system liquidity. And I think this situation of persistent tightness in banking system liquidity has now continued for many months now, with the call rate, in fact, above the upper band of the policy corridor, which is the MSF rate. So essentially, something needs to be done about this in terms of injecting more liquidity, probably right now more via the frictional instruments that the RBI has, such as longer dated VRR. But if that by itself is not able to resolve the issue, then I think more policy measures will be needed. Yes, the sequencing, I think globally now the discussion is towards the timing and the pace of policy easing across central banks. And we do think a similar discussion is going to start in India with respect to the sequencing of the policy exit. We do think that the sequencing is going to begin with liquidity easing measures from the Reserve Bank of India, some of which could get announced in the policy decision that's coming up in early Feb, more via frictional tools to deal with this tight banking system liquidity. But over the coming months, we do think the policy stance of withdrawal of accommodation is a bit stale and should be changing back to neutral to remove that tightening bias. And third, then following through with respect to more repo rate cuts. If we take a step back here, I think while the headline growth numbers have been stronger than expected, I think the composition of growth has not been up to where we would like it to be in terms of broad-based growth. And second, despite the recurrent food price shocks, We have seen core inflation disinflate faster than expected. We are right now sitting at 3.8% on core inflation. The annualized momentum there is actually running closer to 3.5%. So I think that should give a lot of comfort to the MPC, because while we are in a 3 to 6 month period of higher headline inflation for most part of June 2024 onwards until end of FY25, we do see headline inflation converging to core inflation around 4%. So very high real interest rates should be one reason the MPC discusses and then decides to actually cut the repo rate.
I wanted to get your micro thoughts here, just getting a little granular. What do you think could be some of the focus areas in the interim budget? There is a lot of chatter that perhaps there could be something announced for housing, for instance, for the urban poor and the other minority groups. Just wanted to understand your own thoughts here.
Yeah, so, as I'd mentioned earlier, I think our view is that the budget will be aligned with the BJP's thrust on this Gyan strategy. So for the Garib or the poor, in terms of more affordable housing, but also higher allocations on pension, potentially on the insurance side. Enhanced coverage on that front. For the farmer and related categories, constituents, we think the allocation under PM Kisan could be increased from 6,000 rupees to 8,000 rupees, for instance. The crop insurance, cover that they have, that could be expanded to include, health and life insurance as well, for instance. Then for the women, I think this has been one area that is both economically as well as politically quite important. One of the potential expectations here is for doubling the allocations that are given to land owning women. Already we have seen allocations under the LPG gas cylinder actually go up. So that has already happened. And I think finally, as you were mentioning on the affordable housing side, expanding the coverage in terms of interest rate subsidy for lower income and middle income houses in urban areas. That's one possibility. On the income tax side, the old exemption regime that could be extended for some more time. So I think we do have some existing schemes that can be extended or expanded, or some new schemes focused on specific constituents that could get announced in this specific budget. I think the other thing I would flag is, while we're discussing this as an interim budget, if we look back at the last two interim budgets, the fiscal deficit that was given in the final budget in July was actually largely similar to the initial intent that was penciled in the interim budget in February. So whatever it is that the government shows on the interim budget, we do think that those numbers and allocations will be retained when the final budget is presented in July.
Yeah. Pranjul, just closing thoughts here. What we've seen in this current fiscal is the urbanization of the Indian consumer and the economy per se, whereas the rural end is what has been marred and has been suffering and seen a degrowth. Do you think this interim budget could have some specific announcement to try and bump up the rural end of the economy?
Well, look, the one thing that we've not yet been able to do are the farm laws. So, and I think to really bump up the rural economy at a time when climate change is leading to things like, more volatile rains, you need far more reforms and not just like, one or two programs here and there that bring some temporary help. So I think this is a multi-year agenda to really help out the rural economy at a time when there's so many climate change events happening. But having said that, I really must say that while the predominant occupation in rural India is agriculture and cropping, the second most important occupation is construction. And here there is some good news. I think the fact that construction is doing very well in urban India A lot of it has been state-sponsored last couple of years with central government, state government doing a lot of capex, but also, housing, real estate really taking off after the pandemic. My sense is this construction-led activity has given us alternate source of income to rural India. And here, if you take a step back, actually all of these things come in cycles. I think we're on the upward side of a new financial cycles, and things like credit growth, housing prices, construction activity, they all move in cycles. And once you're in the upward side of a cycle, that can last about 2 to 3 years, if you're prudent with your policies. And we are thankfully there right now. And that's why today, even though crop production was weak for rural India, they did get help from the construction sector, because a lot of them and just worked there. So I think this is something which my sense is the government does acknowledge, and a lot of the government programs will be focused on that to some extent. I agree with Sonal that maybe we can get something to keep the housing part alive, MSME part alive, and maybe higher PM Kisan cash transfers. I think these are all sort of small contributors, but I think the big theme will be that construction will be supportive of rural incomes over the next couple of years.
Absolutely, and no one can deny the multiplier effect that it has on the economy. But Pranjul, Sonal, both of you, thank you so much for taking the time out and speaking with us on what you're expecting from the interim budget this time. Thank you.
Thank you.